Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. Today, we're diving deep into a market that feels pulled in two directions, really. You've got this immediate kind of acute panic over a potential U.S. government shutdown, right? But then there's this longer-term high-stakes game playing out globally, things supply chains, chips, critical minerals. Our goal here is to pull together the key threads from, CNBC, Bloomberg, Reuters, and Yahoo Finance and figure out what's really moving the needle for your portfolio this Tuesday. It's September 30th, 2025.
That tension is definitely the story, and it really starts in Washington, doesn't it? We're literally hours from the deadline, and this political gridlock, it's directly messing with the market's need for clarity on the economy. It's like thick fog rolling in just when you need to see the path ahead.
Okay, so let's break down the politics first. What's the latest? Reports from CNBC and Yahoo Finance are saying that after talks broke down yesterday between lawmakers and President Trump, the odds of a shutdown starting Wednesday, October 1st, well, they've jumped significantly.
Yeah, prediction markets are putting it at, 70% now? That's high.
A 70% chance of failure to reach a deal.
And the fight itself is, well, it's frustratingly specific. But the positions seem really dug in. Democrats are demanding the stopgap bill includes protections for those enhanced Obamacare tax credits.
While Republicans are insisting on a clean bill, no
Sure.
extras.
Exactly. And you hear it in the quotes. Vice President J.D. Vance reportedly said, I think we're headed to a shutdown because the Democrats won't do the right thing. So, yeah, not much compromise in the air.
Okay, so the political noise is loud. But for us, the key is the actual impact, right? I saw Jim Cramer, for instance, was advising investors to keep calm and carry on. He mentioned past shutdowns didn't always hit stocks hard. Is the market maybe overdoing the worry about D.C. drama this time?
I don't think so. Not this time. Because looking back at history, it misses the main danger now, which is all about the data, the economic data.
How so?
Well, if the government shuts down, key agencies close. That includes the Bureau of Labor Statistics, the BLS.
Ah, okay. The people who give us the jobs numbers.
Precisely. So the big September jobs report, which we're expecting Friday, it gets delayed indefinitely, maybe.
And that matters because the Fed, Jerome Powell,
Yeah.
they need that data for interest rate decisions.
Exactly right. I mean, Wall Street's basically pricing in 2 more rate cuts this year. But if Powell doesn't get the numbers, he's navigating, as Reuters put it, a foggier sea.
Right. Hard to make decisions without the map.
It makes the Fed hesitant. It could push back those rate cuts everyone's expecting. So while Cramer says stocks might shrug it off initially, some analysts are saying each week of a shutdown could shave like 10 to 15 basis points off GDP growth.
Okay, that's not insignificant if it drags on.
No, it adds up. It becomes a real economic drag.
And we're seeing this fear play out in the markets right now, aren't we? Futures this morning.
Yeah, definitely a risk-off move. U.S. stock futures, the Dow and S&P 500 were down about 0.2% earlier.
And bonds?
Bonds are rallying. Bloomberg pointed out treasuries are actually set for a third straight quarter of gains.
Third straight quarter.
Yeah. The 10-year yield is down, sitting around 4.13%. That's that classic flight to quality trade.
Investors getting nervous about growth, heading for safety.
Exactly. They think a shutdown will slow things down, so government debt looks safer. And then there's gold. Just look at gold.
What's happening there?
It surged, hit a new record high, according to Yahoo Finance. $3,867.25 an ounce.
Just purely on shutdown fears.
Pretty much. Classic safe haven buying kicking in.
Okay, so that's the immediate fire drill in D.C. Let's shift gears a bit. Pivot east. Look at the Asia-Pacific markets. They seemed a bit mixed overnight, reacting to China's manufacturing data. CNBC covered this quite a bit. It sounds like there's some nuance here.
Yeah, you really have to look at the 2 main reports. There's the official manufacturing PMI. It came in at 49.8. Now remember, 50 is the line between expansion and contraction.
So still shrinking, but maybe not as bad as feared?
Exactly. It's the 6th month below 50, so contraction continues. But it beat expectations slightly. They expected 49.6, and it was the best reading since March. So less bad.
Less bad, okay. But then there was a private survey, too. And that looked better.
Right, the private one, the Rating Dog PMI, that often covers smaller firms, maybe more export-focused ones, and it came in at 51.2. That's above 50, so expansion.
Oh, interesting.
Yeah, beat forecasts handily and was the best reading since May, apparently driven by rising new orders and production picking up.
So what's the takeaway from that split?
It might suggest that the part of China's economy geared towards global demand, the exporters, could be doing a bit better than the broader domestic-focused, maybe state-owned sector reflected in the official numbers. It's a divergence worth watching.
Okay. And moving south, down under, Australia's central bank, the RBA.
They held rates steady. Benchmark policy rate stays at 3.6%, which was pretty much what everyone expected.
Any reason given? Inflation's still the issue.
Yeah, that seems to be the main thing, according to the reports. Inflation is still sticky, came in at 3% in August. That's the highest since July 2024.
Driven by what, mainly?
Mostly housing costs, food, and alcohol prices still rising. So the RBA seems happy to just wait and see for now. Needs clearer signs inflation is cooling off properly.
Makes sense. And just wrapping up the region market moves.
A bit down in Japan, the Nikkei fell about 0.25%. South Korea's Kospi also down slightly, around 0.19%.
But China and Hong Kong were up.
Yeah, mainland China's CSI 300 added almost 0.5%, and Hong Kong's Hang Seng did even better, up nearly a full percent.
Anything specific driving Hong Kong?
Well, speaking of gold, there was a huge debut. China's Zijin gold shares just skyrocketed.
How much?
Over 60% on their first day trading in Hong Kong, clearly catching that global wave of demand for gold we talked about.
Wow, okay. 60%. Not bad for a debut. All right, let's shift from that sort of immediate market reaction, the shutdown trade, to the bigger, maybe slower-burning structural issues, geopolitics, chips, tariffs, minerals. This is where the really deep, expensive strategic moves are happening.
Absolutely. This is the long game. And the U.S. strategy on semiconductors, well, it's becoming really clear it's a national security priority now. We saw reports on CNBC that the U.S. Commerce Secretary, Howard Lutnick, is actively pushing Taiwan, pushing them hard.
Pushing them to do what?
To basically shift their chip production. He's talking about a 50-50 split, wants half of America's critical chips made domestically in the U.S.
Okay, sounds huge and expensive.
It is. Lutnick's goal is apparently 40% domestic production by the end of Trump's term. That needs something like over $500 billion in local investment.
Wow, $500 billion?
Yeah.
And what about the old idea, the silicon shield?
He's dismissing it. That theory, that Taiwan's dominance in advanced chips making over 90% actually protected it. Lutnick seems to view that reliance as the core risk now.
But wait, isn't that a fundamental shift? If the U.S. builds up its own capacity, does that actually make Taiwan safer, or does it remove that shield?
That's the multi-billion-dollar question, isn't it?
Yeah.
Lutnick's argument coming through in Bloomberg reports seems to be that depending on any distant, potentially vulnerable source for something so critical is just too big a security risk, regardless of deterrence theories.
So the $500 billion investment is basically seen as like an insurance premium against geopolitical disaster.
Pretty much paying for resilience.
And this strategic push goes beyond just chips, right? Tariffs are back in the news.
Yep. President Trump announced new tariffs, 10% on imported timber and lumber, and an initial 25% duty on imported kitchen cabinets and furniture.
Okay, new tariffs. But what's really interesting is how they're doing this, especially with the shutdown looming.
Exactly. Bloomberg highlighted this. Even if the government shuts down, the administration says it will keep pursuing its Section 232 investigations.
Section 232. Remind us what that is again.
That's the key. Section 232 lets the president impose tariffs based on national security grounds. It kind of bypasses the usual trade rules, so they're continuing these probes into imports like semiconductors, critical minerals, even aircraft, arguing national security overrides congressional funding issues for this.
So the message is, the trade strategy continues, shutdown or no shutdown. It's seen as essential above the political fray.
That seems to be the signal, yes. This isn't stopping.
And you mentioned critical minerals. There's a new approach there, too, using Wall Street tools.
Yeah, this was fascinating, reported by Bloomberg. Instead of just grants or loans, the administration is looking at acquiring warrants.
Warrants, like stock options.
Sort of. It gives the government the option to buy shares in critical mineral companies later, at a set price. They're even looking at Australian firms.
Why warrants? What's the advantage?
It seems to follow the playbook from the Pentagon's $400 million stake in MP Materials, the rare earth producer. Using warrants could be a faster, more flexible way to inject capital and align incentives, aiming to build up that domestic supply chain much quicker to counter China's dominance.
Faster capital, more alignment. It's a more aggressive, market-oriented approach to supply chain security.
It definitely is. And all this maneuvering, the U.S. focus, the China focus, it's creating anxiety elsewhere. There was a really stark warning from Europe. The head of France's state investment bank, Bpifrance,
What do they say?
he put it bluntly, said Europe is being doubly colonized, industrially colonized by the Chinese, digitally colonized by the U.S.
Oof. Doubly colonized. That's quite a statement.
It really captures that feeling of being squeezed between these two giants reshoring and building their own tech and industrial ecosystems.
Okay, let's bring it back home, wrap up with some key moves in tech, M&A, and specific stocks people are watching. First up, big tech seems to be settling some old scores with the administration.
Yeah, it looks like a pattern. Google's YouTube just agreed to pay $24.5 million. That settles President Trump's lawsuit over his suspension back after January 6th, 2021.
And that follows other settlements, right?
It does. Meta, Facebook's parent, settled for $25 million, and X, formerly Twitter, settled for an estimated $10 million.
So clearing the decks legally.
Seems like it. The reports on CNBC and Yahoo Finance do stress these settlements aren't admissions of any fault or liability. But yeah, resolving these disputes.
Okay. Shifting to AI development, seeing very different paths being taken by U.S. and Chinese firms here.
Yeah, it's a really clear contrast. You have Anthropic, a U.S. company launching Claude Sonnet 4.5. They're billing it as the best coding model in the world. Pure power play.
Aiming for top performance.
Right. Then you look at China's DeepSeek. They launched an experimental model, V3.2XP, and its whole focus is different. It's about sparse attention.
Sparse attention. What does that mean in practical terms? Why should we care?
It's all about efficiency. Basically, the AI tries to ignore data it thinks isn't important to cut down on the processing needed. The goal: cut running costs in half. Make powerful AI cheaper to run, more accessible.
Especially using Chinese chips.
Exactly. DeepSeek says it runs right out of the box on Chinese-made chips. So it's an efficiency and accessibility strategy.
But there must be a downside, right? If it's ignoring data.
That's the concern analysts flagged on CNBC. You might lose nuance. Reliability could suffer compared to models that crunch all the data. It's that classic trade-off. Cost versus potentially lower fidelity.
Interesting. Cost efficiency versus raw power. And maybe reliability. Very different bets being placed.
Very different philosophies driving development right now.
Okay, finally, some company specifics. Big M&A news in gaming.
Huge deal. Electronic Arts EA stock popped. News of a $55 billion deal to take the company private.
$55 billion. Who's behind it?
It's a consortium. CNBC reported it includes the Public Investment Fund of Saudi Arabia, the PIF, along with Silver Lake and Affinity Partners. Big players.
Definitely. And Nike earnings are coming up.
Yeah, after the bell today, Tuesday. And Nike's under pressure. The stock's had, what, 5 straight down weeks?
Ouch.
Yeah, down over 10% just in September. So investors will be digging into those results, and especially the guidance, looking for signs of a turnaround, according to Reuters.
Lots of writing on that report. And quickly, any Cramer highlights?
Just a few from his lightning round. He recommended buying Brinker International, said it was good for younger investors. Called American Superconductor an interesting spec.
A spec, okay.
And he blessed United States antimony, called it a spec too, but one that actually makes money.
High praise for a spec from Cramer.
Whoa.
Okay, so let's step back, try to pull this all together.
It really is a strange picture, isn't it? You've got this paradox playing out. On one hand, some surprising short-term resilience. Bloomberg noted emerging market stocks are actually heading for their longest monthly rally in over 2 decades.
21 years, wow, despite everything.
Right, and you see haven assets like treasuries gaining, so there's pockets of strength or at least stability.
But underneath that surface.
Underneath, you have these really severe structural risks brewing. The shutdown threatening the Fed's data lifeline, that's immediate. And then this intense geopolitical friction, actively forcing supply chains for critical things like chips and minerals to fragment globally. That's long-term, but potentially massive.
So it leads to a big question for listeners, doesn't it?
I think so. You have to ask, what's the ultimate price tag on all this geopolitical rivalry? The U.S. is pouring potentially $500 billion into securing its own supply chains. China is racing for cost-efficient AI that runs on their chips. Does this divergence, this fragmentation, does it actually lead to a world that's less reliable overall? Maybe more diversified, sure, but maybe less efficient, less dependable technologically and economically.
A more secure but perhaps less optimal future. Who wins that trade-off?
Exactly. Is it a zero-sum game between domestic security and global efficiency? Something definitely worth thinking about.
Absolutely. Fascinating questions for a world pulling apart. That wraps up our deep dive for today. Thanks for tuning in. And we'll see you all tomorrow morning with new headlines from major financial magazines.